Shorts. My name is Tina Schackman, and I'm here today to talk about taking a loan from your retirement account. Retirement accounts are designed to help people save and invest to reach their retirement goals. However, we do know that life does get in the way sometimes, and it may force people to make tough decisions, like taking a loan from their retirement account to pay for unforeseen expenses, or maybe make a down payment on a home. A loan from your retirement account is not a loan in the traditional sense, in that there's not a lender involved that's going to run your credit history or check your credit score before approving the loan. And the interest that's charged on the loan is credited back to your retirement account. It's not an additional expense that's incurred. Here's some things to consider if you're thinking of taking out a loan in your 401k or 403b account. Number one, make sure that you've explored all of the options before taking out a loan, as it could impair your retirement savings goals. Number two, check with your employer on the specific rules around taking out a loan in your plan. Not all plans allow loans, and there may be some restrictions or limitations on how the loan can be used. And finally, number three, if you do decide to take out a loan, make sure that you understand the terms of the loan, the amount of the loan payment, and what happens if you leave your current employer. Most plans only allow you to make loan payments through payroll deduction while you're currently employed. So you may need to actually pay the entire remaining balance upon termination if your loan doesn't allow for that. The rules for taking out a loan from a retirement account generally state that you can take 50% of your vested account balance up to $50,000 in a 12-month period. And also there are considerations as to whether the employer contributions or Roth contributions would be allowed or included in the loan amount. So you do want to make sure that you speak with someone at your company or your plan's administrator to make sure that you understand the plan's specific rules around loans. The loan is borrowed money and will need to be paid back in 5 years for a general purpose loan or 15 years for a residential loan plus the interest. And unlike a distribution, you don't have to pay any taxes or early withdrawal penalties. But if you do find yourself in a situation where you're not able to make the loan payments, it could be defaulted, and then it is treated as a distribution where you would end up having to pay income tax on that remaining balance during that tax year. Not to mention the fact that you would miss out on investing the money back into your tax-advantaged retirement account. So it's important to do everything that you can to avoid defaulting on your loan. And one thing that we do see happen when people do take out a loan is they stop making contributions into their retirement account while they're paying off the loan. And I can't stress enough how important it is to try and make regular contributions, even if it's at a reduced amount, just to make sure that you're staying on track for your retirement. So in a nutshell, if you need funds quickly, a loan from your retirement account may make sense, but make sure that you understand all of the terms of the loan and you have the capacity to pay it back. Thanks for listening.